All right, homies and homettes, good morning. It is October 13th, 4 days from my birthday, just in case anyone's keeping track. But let's get jumping in here. I've got maybe 15 or so minutes, and then I got to hit the road, bang out a couple of errands here before the market opens. I got to get to the post office. I got all kinds of stuff to do. But let's get diving in here, y'all. I always appreciate you spending a few minutes with me. So here's a spreadsheet that we're working with in my mastery. We call it the Bob, the Book of Business. So here's our current game plan. Until the indexes, and mind you, this hasn't really changed over the last week or so. Until the indexes get 2 to 3 strong, solid, legit closes back above that daily 21 EMA, we're looking for the path of least resistance to be to the downside. Therefore, it's a short the bounce kind of market. Now, pick your spots wisely. I wouldn't suggest shorting the market after we flush 2 to 3%. You want to short after the bounce back towards the 21 EMA, which is what we did last week. Now, the only difficulty here, and I'm going to give you a really key level, I think, of support, is your weekly 21 EMA. Let's take a few minutes and look at this. So your daily chart all the way down to your 15-minute. It's like you're losing structure, you're losing momentum. It's nasty stuff here. Yet it's tough for me to say this market's in a downtrend when all we've really done is pull back to weekly support. So you're getting, definitely, I think, a shortable structure on your daily chart, your lower time frames. We're not getting that kind of rapid continuation to the downside because weekly support does continue to hold up here. So I would imagine come Friday, if we can finally close underneath the weekly 21, then I think you get some downside. And at that point, then I think you get easier shorts here. If we can dump under weekly support, then I think the next bounce is going to be the easy short. So you can look to get shorts here. Just probably not going to get too much going until you can crack support. And the same goes for the QQQ. A totally busted up daily chart. Momentum basically everywhere is pretty horrendous. However, you still got that big line in the sand. So I think you keep an eye on that into the end of the week. And quite frankly, I'm not spending too much time on the individual stocks here. So there's plenty of bullish setups. There's plenty of things like Team. That's beautiful. AON is a thing of beauty. I think Match.com is pretty damn solid. Home Depot looks pretty good. Lowe's looks pretty good. Netflix has been on crack here. And then there's Tesla. Tesla's probably my favorite for a little bit more upside into earnings. So, you can make your argument. There's plenty of things to get long right now. And I would actually tend to agree. The major thing we got to keep in the back of our mind, or rather at the front of our mind, you have no bullish structure here to your market. So I know I'm super repetitive during our morning sessions, but there's a reason behind it. Back in August, there was daily squeezes in Facebook, Apple, Tesla, daily squeezes everywhere. Almost every single one of them worked beautifully because of this bullish structure to the market. The market itself was in a squeeze. You're at the buy zone. You're in an uptrend. Histogram's positive. There's positively stacked DMAs. So if the market is setting up like that, at Facebook daily squeeze, that's an easy trade. The Apple daily squeeze is an easy trade. Something super random like real estate, it's an easy trade. If you're a Microsoft fan, they're all easy trades there. Same setups, same structures, all easy trades back here in August because you had that good structure to the market. So take into consideration right now, if you get long, something like a Team, I'm with you as far as this thing looks pretty damn solid. The market doesn't. So it means you either completely ignore these kinds of things to the upside, or you just simply make a few adjustments. Scale down a position size. Maybe you give your swing trades 30 days to work instead of 3 days to work. Just make a few adjustments, accepting the fact until the market cleans up a little bit. Team looks good, sure. Netflix looks good. Just accept the fact you're going against the grain of the overall market. There's a very, very slim chance you're going to have the same win rate, the same kind of high probability nature to these trades right now versus back in April, May, June, July, August. So keep that in mind, my friends. So while I do think potentially, especially if we break the weekly 21, we get some nice downside next week, This week so far has been a bit of a chop fest. It does look like that could continue. It's monthly expiration. So this Friday, they're going to be looking to pin some stuff. So what could make for some decent weekly income here actually could be iron condors on the index, which, to be transparent, I'm typically not too interested in selling condors on the market when we're under the 21 EMA. And the reason being is typically if you're under the 21, there's a little bit of potential for some slippage here. However, we were doing the live trading in the mastery yesterday. Somebody mentioned JC did a condor, so we start looking at the options chain. There's actually some serious premium here, which to me was a pleasant surprise. So I really wasn't even thinking, yeah, let's do iron condors here. But once you start to look at the premium and the risk reward, actually makes a little bit of sense. So we did a few of those in the mastery. For smaller accounts, I did one here on the SPY for Friday's expiration. So on the call side, we're selling calls at 447. On the put side, we're down here at 425. It's a pretty high probability trade. Now, on paper, the risk reward looks a little bit sketchy, but this is where getting comfortable with the Analyze tab here on Thinkorswim is really helpful. So, for example, depending on how today goes, I might look to get the mastery into another iron condor that expires on Monday. Maybe we take that paycheck on Friday. Maybe we take it at Monday's open. But for conversation's sake here, you could set up an iron condor on the SPX for this coming Monday's expiration. Selling calls up here at 44.70 and selling puts down here at 42.70. So if we price that trade out, the risk reward isn't going to look all that attractive in terms of max profit, max loss. But what I want to show you is the 18th. That will be Monday. So peep this, right? If we come down, let's do 42.70, 42.60. On the call side here, let's do, we'll do, I think I'm on the wrong day here. What freaking day am I on? No, I need October 18th. Bear with me. There we go, October 18th. All right, so if we go to 42.70, 42.60, we'll go 10 smackers wide here. Call side, let's go 44.70, 44.80. And we'll look at this on a one contract basis. All right, $1.80 a credit. So for conversation's sake, let's say you could get $1.80 here. All right, so per contract, max profit of $175 for a max loss of $825. So I know for most options traders, especially newer options traders, if you're talking about risking $800, you're trying to make a couple thousand. It's pretty solid when it works, but in terms of consistency, we want to take a deeper look at this because there's best case scenario, worst case scenario. The real question is, what has to happen for us to lose the $800? I think an even more important question, we got no headaches here if we're under our short strikes. So what's our loss going to look like come Monday morning if we're ripping through our short strike on the call side at 44.70 or our put strike down here at 42.70? That's what really matters most. So if we analyze this bad boy, let us analyze it. All right, so Monday the 18th. So let's say Monday morning market opens up. We're ripping towards that out the money call we sold at 44.70. We're going to be down about $250. I'm going to round up here just to give it some wiggle room. Let's say it's going to be minus $300. And if we're down here to the put side at 42.70, $200 and change, again, I'm going to round up and say we're down 300. So if you get that move into Monday's expiration, into either of your short strikes, you're probably down, call it $300 per contract. That's kind of worst case scenario. And if we go nowhere near those short strikes, you stand to walk away with about $170. So you round up here, you're really risking 300 to make it closer to 200. But because it's a high probability trade and there's no free lunch here on Wall Street, you got to put up a little bit of cash to get the high probability paycheck. but this is where that Analyze tab is pretty useful. So depending on how today goes, we might look to do basically that same exact trade here in the Mastery for Monday's expiration. And if we can get 70, 80, 50, 60% of max profit, just looking to take home a little paycheck there. But those are, I think, a few ideas to work with over the next few days. But heading into next week, I would be looking more directional. And unless the structure completely changes into the weekend, I would be looking to the downside. So those are a few things I got for you. And as far as the short that we have on the market, because we're not breaking weekly support yet, because I can't quite call this a downtrend just yet, I think if you're looking to set up a short here, you do it in a fashion where, set it and forget it kind of mentality. Very low risk, potentially big reward. So what we got here for SPX, I think we put this on last Thursday, last Friday. We went out to November 5th. But we did a little bit different here. We sold an in-the-money call credit spread, which obviously means for this trade to go perfect, the SPX is going to have to trade under 4,300 at some point this month. But because you got some big old premium here, we got filled, I think, at 765. I did 25 contracts personally, doing like a 3% risk. Actually, my position size doesn't matter. I'll show you on one contract here. So with a fill at 765, we're risking $235 to make just about $800. Again, if the market actually rips, though, back up here to like 4,500, we're only going to lose like half of our max loss. So if you risk 3%, you're risking really 1.5-ish% to maybe grow your account by 6, 7, 8+%. But you do need to move under 4,300 for that to really get cranking there. So, we've already brought in like 60 cents or so a premium. But where I'm going to look to get a bit more aggressive with my shorts is when we can get under weekly support. Then I'm going to look for potentially bigger position sizes at the money call credit spreads, a little bit more aggressive. But at least as of right now, if the market dumps, then we got a really solid trade on our hands. If, in fact, the market just goes back to the highs, it's going to be a paper cut, and we'll keep it moving. And to me, that makes the most sense here until that pesky weekly 21 can give out here. But that is my advice. I'm just not spending too much time right now. The Home Depots, the Lowe's of the world. Here's my thought process. If the market just kind of gets back on its own 2 feet, and lo and behold, into mid-October here into end of November or early November rather, if the market just gets back on track into rally mode to the upside, I'm completely okay with missing LOW. Like, I don't got to catch the first few stocks that are going to move with the market. If we do go back into an uptrend, then I'll start running my scans and I'll just take whatever squeeze is available. There's always going to be some opportunity there. So that FOMO aspect, man, if I don't get long right now, I might miss Home Depot. I might miss Lowe's. It's kind of silly. It doesn't really matter. If you're looking to play the path of least resistance, tough to argue as to the upside here. And if the day comes that it is to the upside, then I think you make your adjustments, you start getting long. Until then, though, could be a tad bit sketch. Your volatility index just keeps lingering here. But that's what I got for you, y'all. I'm looking for some downside next week, avoiding getting long right now, and just trying to collect a little bit of premium over the next few days. So I hope you find that helpful. Let me get caught up in the chat here before I hit the road real quick. If it's blurry, guys, I'm sorry to hear that. Unfortunately, I don't think I can control that on my end. So Evolving Steve, I use 2 scans. I use a TTM squeeze scan here on Thinkorswim, and then I also use the scanner on the Simpler website. And they got a few things on there that kind of built out for me. So the Simpler scanner here is great. And if any of you use this, The focus scans at the top here, the focus scans, those are kind of tailored towards the kinds of things I like to focus on with y'all. Amelia, we're breaking YouTube. We're breaking the tube here. So mind's eye, the reason I can't call it a downtrend yet is if we look at a weekly chart, which I really like to gauge trend based on the weekly chart. Up to this point, we just got really extended and we've pulled back to the mean. Now your daily charts, your 4 hours, your 30 minutes, they've taken quite the whooping here. But just in terms of the weekly structure and trend, there's no bullish momentum here and we're still holding support. So personally, while I do think the market is going to go lower, I can't quite call it a downtrend if the weekly chart still looks incredibly solid. So that pullback right there, I wouldn't be able to call that a downtrend. I couldn't call that a downtrend, couldn't call that a downtrend. Now, something like this over here. Granted, that was what? Coronavirus. But once you lose that weekly structure, that to me is when the market is a little bit easier to short. When you break through support here, notice how we're just holding up. So we get that big flush, but it's down to the weekly 21 and we bounce. We get our next big flush down to the weekly 21, you bounce. Little flush, you're holding up at the 21. Difficult to get crazy traction trying to short it here. What I think is if we can break through the weekly 21, then you're looking to short that next bounce. Because that next bounce isn't going to have that big weekly support to save it. That's kind of my mindset here. Hopefully that makes sense. I'm trying to find a good example of a weekly chart. So like Roku. I think difficult to short it at the weekly 21. You break that weekly trend in structure. Now I think as you're short and bounces on a daily chart, you're it's much easier to catch that path of least resistance to the downside. That's my thought process here. We'll see if we can crack it this week. Oh, YouTube listened up? All right. Whoever put in a phone call, I appreciate it. Yeah, we are flat here heading into the open. But all right, y'all, let me hit the road here. Always good to spend a few minutes with you. And hopefully this gave you a few things to take into consideration. So I do think the condors could offer some nice little weekly income here from now up until Monday. But I do think, as you're doing your weekend prep here, keep a close eye on that weekly 21. Market tries to let it go. It holds the support, tries to let it go, tries to let it go. I think if we get our first close under support here this week, then you got some solid downside. Now, obviously, as always, the market's going to do whatever the heck it's got in mind. This is just what I'm thinking right now. So we'll see if me and Mama Market are on the same page. But I appreciate y'all. Hope you have an awesome Wednesday. Trade safe, trade smart, be disciplined, and I'll talk to y'all soon.